Greetings and welcome back to the lesson. We continue with the subject financial management. The topic is Introduction to Capital Structure Decisions. In our last session, we introduced the weighted average cost of capital. We explained what it is all about. We did an illustration. Today we move on to the weighted marginal cost of capital. By the end of this lesson, you should be able to calculate the weighted marginal cost of capital, WMCC. But first of all, let us define weighted marginal cost of capital. Now, the weighted marginal cost of capital is the cost of additional amount of capital which is raised by a company for funding fixed capital investments. So it is the cost of additional amount of capital. It is the cost of additional amount of capital. So the keyword here is additional. So WMCC is calculated where a company is already in existence, but maybe it has a project that it has to undertake, a capital project, an investment project, which requires additional capital. So the cost of that additional capital is what we are referring to as the weighted marginal cost of capital. The weighted marginal cost of capital is the cost of additional amount of capital. That's all you need to know, and I hope you've understood. Weighted marginal cost of capital, that's the definition that you need to know as far as the definition is concerned. If a company desires to raise additional capital to fund its capital projects, the cost of that additional capital is what we are referring to as the weighted marginal cost of capital. And there are just 3 steps in calculating the weighted marginal cost of capital. The first step is to compute cost of specific sources of capital. Sources of capital. Step number 1, compute cost of specific sources of capital. Compute cost of specific sources of capital. So if the additional capital is to be raised from retained earnings or debt or preference shares, then the cost of each source should be first computed. You compute the cost of debt, the cost of preference shares, the cost of retained earnings. Step number 1. Step number 2, compute the marginal weights. Compute the marginal weights of the sources of capital required for additional financing. Compute marginal weights. Then the third step is to multiply the marginal weights with the specific cost of capital. You multiply the cost of the specific sources of capital with marginal weights. Multiply 1 and 2. above. Multiply the specific cost of sources of capital with the marginal weights to get the weighted marginal cost of capital. Yeah, I was at point number 3. We are studying the subtopic weighted marginal cost of capital. We've defined weighted marginal cost of capital as the cost of additional amount of capital. If a company desires to raise additional amount of capital, that capital comes at a cost. The calculation of the additional amount of capital is what you are referring to as the weighted marginal cost of capital, and there are just 3 steps in the calculation of the weighted marginal cost of capital. Step number 1 is to compute the cost of the specific sources of capital. If you are raising capital from debt and retained earnings, then you first calculate the cost of retained earnings, that is KR, and the cost of debt, that is KD. Then step number 2 is to compute the marginal weights. Then you multiply the cost of specific sources of capital with the marginal weights to get the weighted marginal cost of capital. Illustration. So that is the illustration. First of all, we have the capital structure comprising of debentures, ordinary share capital, and retained earnings. The management of Summer Limited intends to invest in a project estimated to cost 6.8 million. The cost of the project will be raised as follows. We see it's from debentures, preference shares, and issue ordinary shares. Then there is utilize the retained earnings. Utilize the retained earnings. You are required to calculate the weighted marginal cost of capital. Illustration. Now, the formula for weighted marginal cost of capital is derived from step number 3. Multiply the cost of specific sources of capital with the marginal weights. In this question, we have 4 sources. We have 4 sources. The first source is the cost of debentures, abbreviated as KD. We know that is the abbreviation for cost of debentures. Okay? Cost of debentures. Then we multiply this cost with the weight of the debenture, marginal weight, WD. We are multiplying 1 and 2, 1 and 2. So the cost, the first one is cost of debentures. Do you see that? Then you have preference shares. Preference shares, cost abbreviated as KP, plus the weight of preference shares. Then we add the third source will be obtained from ordinary shares, KE, abbreviated as KE. Then we multiply with the weight of equity, WE. The fourth source, what is the fourth source? Is retained earnings. Utilize retained earnings. Retained earnings. Utilize retained earnings. So the cost of retained earnings, KR, then the weight of retained earnings. So that is the formula. Anything else is just workings. So step number 1, put down the formula. So that is the formula. So you have to compute cost of specific sources. So the first working will be the cost of specific sources of capital. And the first source is KD. KD. Now you recall in computing cost of debt or cost of debentures, there are two categories or two formulas that can be used. So when you have such a question, you check if these debentures are redeemable or not redeemable. If the debentures are redeemable, the formula is different from if they were irredeemable. So for this case, the debentures are not redeemable because we do not have the maturity period. There is no maturity period, which means that the debentures are not redeemable. They are irredeemable. And we know candidates for irredeemable debentures, the formula is interest over VD1 minus T. So that's the formula for debentures, where int is the interest and VD is the market value of the debenture. The market value of the debenture. So this will be equal to the interest. What will be the interest? Please take us to the question. The interest there is 10%, and the par value, the percent is applied on the par value. The par value of that debenture is 100 shillings. So it's going to be 10% times 100. We divide by the market value of the debenture. What is the market value of the debenture? Issue 10%, 100 debentures, 10%, 100 debentures, 10%, 100 debentures at the current price of 5,000. So it's 5,000. That is the current value. And the book value or the par value can be obtained from the capital structure. So the par value is supposed to be 10% of how much? So the market value of the debenture is 5,000. Do you see that from note number 1? Issue 10%, 100 debentures. 10%, 100 debentures at the current price of 5,000. So one debenture is valued at, the market value is 5,000. I want you to see that. Then I want you to see that the interest has to be applied on the book value. The book value is how much? We know the interest is 10%. The interest is 10%. So what will be the interest in shillings? So it is 10% of 1,000. 10% of 1,000. That is the interest per debenture. This interest in the formula is interest per debenture, and that is the coupon rate. So when calculating debenture, you apply the interest on the par value, the book value per debenture. The 4,900 in the question is the total value of debentures. That is the 1,000 shillings times the number of debentures. You will get 4.9 million. And the VD, which is the denominator, is the market value per debenture. The market value per debenture, in note number 1, we read it. Issue 10%, 100 debentures at the price of 5,000. So a debenture is, the value is 5,000. Then we multiply by 1 minus t. This is 1 minus 0.3. Give me the rate. Someone says 1.4%. 1.4%. That is the cost of the debenture. Then the second source is cost of preference shares. What is the formula? Cost of preference shares. Cost of preference shares, we read in note number 2, issue 89,440, 10%, 20 shillings, preference shares at the market price of 25 shillings. So we know again the cost of preference shares will be D naught, which is cost per the dividend per share. We divide by the market value, P naught, market value of the preference share. Market value of the preference share. If there is flotation cost, we deduct the flotation cost. But for preference shares, I don't see flotation cost there. So what is the dividend per preference share? Dividend per preference share, we have it in note number. Do you have it? Yes. The company's current DPS is 2.25. Is 2.25. That is the ordinary share. Then what is the dividend for preference share? Look at note number 2. Look at note number 2. Candidates, you have to pay attention. These are areas candidates miss and you lose marks. You have to be very keen. As much as the question seems direct, you have to be very accurate. Look at note number 2. Issue 89,440, 10%, 20 shillings, preference share. Look at that. So what is the dividend? The dividend is the 10% of the 20 shillings. That is the DPS. The par value of the preference share is 20 shillings. The dividend is 10%. So dividends in shillings is 10% of the 20 shillings. We divide it by the value of the market value of 25 shillings. So how much is that? What is the cost of preference share? 8%. Someone else can confirm. The third source, according to that information, is issue ordinary shares at the current market price of 45 with flotation cost of 12%. Flotation cost of 12%. So KE will be equal to D naught over P naught minus flotation cost. So the company's current DPS, you are told, is 2.225. That one does not need calculation. The KE is equal to D naught, which is the dividend per share, 2.225. 2.25. That is the DPS. That is the DPS. The market value of this dividend, we read from the question, is 25 shillings. 25 shillings. Then we deduct the flotation cost. We read the flotation cost is 12%. Flotation cost is 12%. So what is the flotation cost in shillings? We deduct the flotation cost here in shillings because the 25 is in shillings. We are given the flotation cost as a percentage. Tell me, somebody, what is the flotation cost in shillings? The market value of the dividend is 45. Correct, 45. 45 is the market price minus. So give me the KE. So this should be 12% of 45 flotation cost. 12% of 45 divided by this will be the flotation cost. You apply the flotation cost on the market value. So what is the KE? Abraham says 11.48. Gilbert says 5.68. 5.68. So is it 5.68? The cost of equity. Cost of equity. Then lastly, we have cost of retained earnings. The formula is D naught over P naught. Now, why are we not deducting flotation cost from the market value of the share when calculating the cost of retained earnings? Correct, Gilbert, that's correct. It's an internal source. We deduct flotation costs because these are costs that are associated with the issuing shares to outsiders. But given that retained earnings is an internal cost, there are no flotation costs. And therefore, the cost of retained earnings will be this 2.25 over 45. We multiply by 100. What is the cost? 5%. Now, candidates, do you see why the cost of retained earnings is cheaper compared to the cost of equity? Is because of these flotation costs. Here there is a flotation cost. That's why cost of issuing shares to outsiders will be more expensive to the company compared to when the company uses these retained earnings. That's why we always say the retained earnings is a cheaper source of finance compared to these other sources. So we have done the first step. We have computed the cost of specific sources of additional capital. So we have the specific sources. Cost of specific sources, you have the cost of debt, 1.4%. Then we have cost of preference, 8%. We have the cost of equity. Cost of equity is how much? 5.68%. 5.68%. Then we have the cost of retained earnings, 5%. So we need to calculate the weights. That will be the second step, calculation of the weights. I'm going to have another working here for weights. I'll maintain this for purposes of explaining the steps. So the second working is computation of margin weights. Margin weights. And the one who asked about the 60%, your question will be answered as we calculate the marginal weights. So let's now move to computation of marginal weights. So we'll have one column for sources of additional capital. And the first source is debentures. And we read from the question that issue 10% 100 debentures at the current market price of 5,000. So what is the total value of debentures? The company is issuing 100 debentures. 1, 2, 3, 4, 5, 6, 7, 8, 9, up to 100. Number of debentures. And the current price of a debenture is 5,000 shillings. So what is the total market value of the debentures? Isn't it simple? 100 times 5,000 shillings. All right? It's just 100 times 5,000 shillings. It is 5,000 shillings. That's the formula, which is equal to 500,000. This is equal to 500,000. Is it not? The second source is preference shares. Preference shares. Now, preference shares, look at the question. Preference shares, look at the information on the preference shares. That is note number 2. Issue 89,440 10% 20 shillings preference shares at the market price of 25 shillings. Now, candidates, we are studying the subject using the English language. Look at that language. Issue 89,440. So that is the number of preference shares because there are no shillings before the 89. So that is number of preference shares. We multiply it with the market price of the preference share, one preference share. So we have the number there, 40, this is 89,440. 89,440 is the number of the preference shares. And each preference share, the market price, the company is going to sell this preference share at 25 shillings. So if you multiply these two, we'll get the number. We'll get the amount. We'll get the value. The second source is number 3, ordinary shares. Ordinary shares. And we read issue ordinary shares at the current market price of 45 shillings with flotation cost of 12 shillings. ordinary shares. We have the shillings per share. We have the 45 shillings per share. Here we have 45 shillings, but we do not have the number of ordinary shares. If you check from the question, there is no amount or quantity of ordinary shares provided. Then the other source is retained earnings. Retained earnings. Retained earnings, what information do we have? We read, utilize 60% of the retained earnings. Do you have the amount for retained earnings? Yes. Look at the capital structure. Retained earnings 6 million. So utilize 60%. So you come here and write 60% of the 6 million. 60% of the 6 million. So these are the market values. Then we'll have the weights. So this is 500,000. So preference shares, what is the value for preference shares? Is it 2236? 2236. 2236. So let me have 3 zeros up here. 2236. 2,236,000. This one, the figure cannot be obtained. 6% of 6 million, I think it's just 3.6 million. 3.6 million. And we read from the question candidates. Look at the question. The management of Sama Limited intends to invest in a project estimated to cost 6.8 million. So the total here is 6.8 million. So if the total is 6.8 million and you have all these figures, so this is the balancing figure. So this is just a balancing figure. This is the balancing figure. Balance figure. You can write it for your revision, sake of revision. The balancing figure. You add all this, deduct from that. So what will be the ordinary share? 10,464. 10,464. 10,464. If that is true, then we can do the weight. The weight for debenture, the debenture will be equal to 500 divided by the 16,800. For preference share, it will be 2236 divided by 16,800. Ordinary share, it will be the 10,464 divided by 16,800. For retained earnings, the weight is 3.6 million divided by 16,800. That's how you calculate the weights. Take the specific market value of the source, divide by the total market value. That will give you the proportion, the proportion, the weight. Give me the proportions. 0.03, 0.03. For preference share, what is the weight? Preference share, 0.029. Ordinary share, What is the proportion? What is the proportion? Just change it. Lord, give me the right one. If it is not 0.29, what is it? 0.13. 0.13. How about ordinary share? 0.62. 0.623. 0.623. Retained earnings. Retained earnings. So this should equal 1.000. So candidates, you need to understand what is happening here. You don't need to memorize. Please don't strive to memorize. When we say weight, it's just a percentage of the total. The debenture, if this is the total amount that is required, that tells you that out of this 16,800, 3% will be obtained from debentures. If you have to convert this into percentage, 3% of 16.8 will be sourced from debentures. 13.3% of this 6.8 will be obtained from different shares. 62.3%, you can see that is more than half. It's more than half, and it is true because this is 10.4 million, this is 16.8. So more than half of this amount will come from ordinary shares. Then 21.4% of the 16.8 will be obtained from retained earnings. That's what we mean by weights. It's just a proportion of the total. Proportions. Weights are proportions. And you can see here, the company would want to invest in a new project. I'm now answering the question that was asked by someone. What's the difference between weighted marginal cost of capital and the weighted average cost of capital? All right. This is a company that is already in operation. The company has a project. The company would want to invest in a project. What does it say? The company, what is the question? The question reads that the management intends to invest in a project. The management intends to invest in a project. And this project is going to cost the company 6.8 million. This company is going to raise this 6.8 million from debentures, preference shares, ordinary shares, and retained earnings. Additional capital. This is additional capital. Already we have the capital structure. You can see at the top there we read that the following data show the capital structure of SAMA. So the 4.8, 4.9, the 18 million, the 60 million, that is already amount that the company has in its capital structure, but it now wants to invest in another project, an additional project. And to be able to raise money from this additional project, the company will have to get money from different sources. So the cost of these additional sources of capital is what we are referring to as the weighted marginal cost of capital. Weighted why? You see, we are weighting. These are weights. This is not cost of one source. There are many sources, and each source is contributing a certain percentage. It has a weight. That's why you have to add all we are computing the specific source, we multiply by the marginal, then we add all of them in this formula to get one cost. To get one cost, what we are calling the weighted marginal cost of capital, one cost. Because you see, there are many specific sources with different costs of capital. The cost of debt is 1.4%. The cost of preference shares is 8%. The cost of equity is 5.68%. The cost of retained earning is 5%. So you need to plug in the proportions, the weights, in order to get one cost of this additional cost of 6.8 per million. 6.8 million. So we already done the cost of debt. We have it there. We have the weight of debt, which is 0.03. 0.03. Cost of preference share, we have it. The weight is 0.133. Cost of equity, the weight is 0.623. 0.623. That is the weight. Then the proportion for retained earnings, 0.214. So when we multiply that and we add, multiply 1 and 2, we will get the weighted marginal cost of capital. How much is it? Gilbert has already done it. That is 5.72%. 5.72% is the weighted marginal cost of capital.